Today, we're going to cover 5 things you should do before you apply for a car loan. I'm Joe Chavarria, and this is another episode of the Joe Credit Show. So before I begin, I need to throw my little disclaimer out there that everything in this video is just generic information purposes only. This is not going to be legal advice, no financial advice, no tax advice, no promises or guarantees are made in this video. This information is purely for information purposes only, provided to the general public. All right, so now we got that disclaimer out of the way. I want to dive into the topic at hand today, which is 5 things you should do before you apply for an auto loan. So first and foremost, let me kind of give you a little framework here as far as the difference between an auto loan and a retail installment contract. Now, it may not mean much to you now, but in the future, knowing this information could probably help you out if you get yourself in a pickle, if you have to end up suing a dealer or a bank. It's important to know the types of contracts that are out there, and so you kind of know exactly what type of transaction you are within. And so really when it comes to auto loan financing or auto financing, there's 2 main contract types. There's others, but there's 2 main ones. I'm not going to talk about leases. I'm talking purely on the purchase side. And so you have an auto loan, and then you have a retail installment contract. Now, I know what you're probably thinking. You didn't know there was 2. You probably thought all of it was auto loans. You thought it was all the same thing, but it's actually 2 different things. And so let me kind of give an example or explain a little bit more in terms of what is the difference. So an auto loan, a real auto loan, is where you go to the bank, you get pre-approved for financing. The bank says, hey, based on your credit, we'll give you an auto loan in the amount of $30,000. And here is a check, or we'll wire the funds whenever you're ready. This is going to be your interest rate. This is going to be your term. Go get the vehicle, and whenever you're ready, submit it to us, and we'll submit the financing. So basically, you're going to the bank first to secure financing, and then with your financing, you're going to buy the vehicle. You go to a dealership or go to a private seller, but you're taking financing with you. Now, that's an auto loan. A retail installment contract is where you go to the dealership. The dealership will basically shotgun your credit around, and a couple banks will say yes, a couple banks will say no. And once you have signed the agreement, once you've signed your contract on the vehicle that you're trying to purchase or finance, the dealership will basically collateralize the debt obligation using a retail installment contract, and then they'll sell that contract to a bank. So the bank or the lender will basically buy up the contract. They're stepping into the dealer's shoes, but essentially there's really no auto loan. There's no advancements of funds given to you, the individual, in that transaction, because really you're just going to the dealership. They are structuring a installment contract. That contract is now the value. That contract is then sold to a lender who's going to buy that contract from them. And essentially, again, there's no auto loan in that scenario. It's just a contract that's basically sold to a lender. And sometimes on credit reports, you'll look at the account type and it'll say auto loan. And if you went to the dealership and you didn't get the money in advance, chances are it's actually an installment contract, which if you ever find yourself in a pickle trying to get bad auto accounts off your report, like repos and charge-offs and things like that, you may be able to use that as ammunition to basically argue that the account type on the report is inaccurate because it is not an auto loan. It is, in fact, an installment contract. So I just wanted to share that before we dive in, so that way you kind of get a good framework of auto loan versus retail installment contract. So thing number 1 that you want to do before you apply for a car loan is you need to check your FICO auto score, not your Credit Karma score, not your Vantage score, not your credit card score that you have in your credit card statement. Not that. You want to see your FICO auto score. And there's really only one place to get your FICO auto score, which is myfico.com. Unfortunately, I don't get a check for saying that. I wish I did. That's just free publicity for those guys, but that really is the only website that's out there, which is myfico.com, and you can get your FICO auto scores. So FICO Auto is very similar to FICO Mortgage. FICO Auto will use FICO version 2.0 for Experian. They'll use 4.0 for TransUnion, 5.0 for Equifax. So most car dealerships or most banks, most auto lenders are going to use FICO version 2, 4, and 5, or some of them will actually use FICO 8, but it's all going to be under the FICO auto score. And all that means is when your FICO score is generated, there's going to be what's called an industry option that's applied to the score. And the industry option is sort of like an influencer. It just means that, here's the base of the FICO score, but I'm an auto lender, so I want to know what's the likelihood of that individual defaulting on an auto loan, because that's really all I care about, because that's the business that I'm in. And so the industry option would basically apply a little bit more influence, a little bit more significance on auto accounts in the past, whether it be auto loans or installment contracts in the past. It'll place a little bit more emphasis on that. So if you had some late pays on an auto loan in the past, or a repossession before in the past, that's definitely going to count against you. It's going to be influenced in a negative direction, because obviously the demonstration of the likelihood of defaulting or completely going ghost on a new installment contract or new auto loan is high based on the past experience on auto loans in the past. So you really want to pay attention to your FICO auto score. Look at your Experian, TransUnion, and Equifax auto score. And if you go to myfico.com, it'll tell you what your FICO auto scores are, broken down by bureau. And probably even before you apply for a car loan or go to the dealership, ask them, what score model is being used. So, because keep in mind, the dealership may not check all three credit bureaus, all three credit agencies. They may just pick one, they may pick two. They may only look at one or two of them. And so you kind of want to know which one they're going to be looking at, maybe call them in advance. And hey, I'm thinking about buying a car. What score do you require? What bureau do you check? So on and so forth. Get some information in advance to kind of know what you're dealing with. And so tip number two, or thing to do, number two is going to be basically something you can do to boost your score. So really the sweet spot is going to be 620 and above. So 620 and above is really going to be the sweet spot for getting financing, especially if you decide to go get your own financing. So something you can do if you're not quite there on your FICO auto score, something you can do is take a look at your open credit cards. So if you have 2, 3, 4, how many credit cards you have, if those balances are not paid down between 1% and 7%, and what I mean by that is, so let's say you have a credit card with a credit limit of $1,000. 1 to 7% of $1,000 would be $10 to $70. So you really want to make sure that the balance is right within that range, because FICO will reward a consumer the most amount of points possible in the utilization component of their score, when the utilization is between 1 and 7%. You would think a zero balance would be the best, but it's actually not as good as a 1 to 7% utilization, or 1 to 7% balance. And so if you have some high balances, consider paying those down as fast as you can. And then you want to call your credit card company just to find out when they will report that information, because credit card companies typically report once per month. And then kind of get the dates of when they're going to be reporting, get your balances paid down before that date. And maybe you want to schedule your loan application, your auto loan application. You probably want to schedule it maybe a couple of days after all of those credit card balances have been updated. That way, when you go and apply, you will have the highest score you possibly can have at that point. And, that can make a big difference in your interest rate. If you can knock your interest rate down 2, 3, 4, maybe 5%, or more, that's going to make a big difference in your payment, a big difference in what you pay back in interest. So something to really consider before going and applying for a car loan is making sure you take a look at all your credit card balances and see, what you can pay down to boost your score before you go and apply. Now I want to talk about an option, basically a lending institution that a lot of people don't know about. I would say probably good half of the population knows about this lending institution. The other half are clueless, had no idea lending institutions, like this existed. So I want to talk about a really good lending institution to go to get your financing secured in advance. That could really give you an interest rate very, very low. But first, before I do that, I want to just let everybody know that if you've been working on your credit, you feel stuck, you're really not getting anywhere, you're not sure where to turn, you've maybe considered hiring a credit bureau company in the past, or have thought about it, but you're just a little skeptical. You don't want to spend thousands of dollars doing it, and flat out you just don't have the time to mess with it. So you're kind of stuck. And I get it. Many of my clients in the past kind of feel it the same way. And that's a big reason why I started my company back in 2012. So if you go to joechavarria.com/links, there's going to be some helpful information there. I have articles that I've written, I have videos that I've created, all kinds of different credit content, tips and resources, all free to the general public. Also a credit monitoring site that I recommend. If you're just going to want to start repairing your credit, you want to keep your monthly costs down and monitor your credit scores, all three bureaus even. There's a link in there for that as well. And if you just want to have your credit looked at by a professional, my team at the Credit Agents will be more than happy to take a thorough look at your credit report, break things down for you item by item. My team at the Credit Agents will actually explain to you how you can fix your credit yourself. And that way, if you wanted to do it on your own and save the money, they'll give you some guidance on how to do that. And now, if you want to just hire them to do all the legwork for you, just don't have the time, they'll provide you with a free quote, no obligation, completely complimentary credit review for you. They'll provide that for you at no cost to just review the report with you, break things down. But if you want to hire them, provide you with a quote and what it will cost to hire them to actually do all the legwork for you, so you can just sit back, relax, and let those guys do all the heavy work for you. So again, go to joechavaria.com/links to get information from tips, videos, articles, credit monitoring service, and of course, to schedule your no risk, no obligation credit review at the Credit Agents if you wish to do that. Again, joechavaria.com/links. Get started. You take advantage of your credit again. Get that going in the right direction so that way it doesn't haunt you for the months or years to come. All right, so now let's talk about the credit institution, lending institution that's out there. A lot of people don't know about, that offers very low, very favorable interest rates and terms. It's a great place to go to before you go and seek financing at the dealership or somewhere else. And that lending institution, that credit institution, is a credit union. So credit unions have been around for decades. They're similar to a bank. They act almost the same way, but they're just not classified as a bank. They're classified as a credit union. And so credit unions are more member focused. A lot of banks are more profit and loss, investor kind of focused. And of course they're account holder, focused too. They're considering the account holders, but where a credit union, they're a little bit more friendly, or a little bit more friendly to individuals or members of the credit union, which are basically people who have, checking accounts with credit unions. So credit unions have been known to offer interest rates on vehicles as low as 2%. Usually you don't get very high with them. They don't have the high score requirement to get approved for a vehicle. Many of them will give you an approval on an auto loan if you're right around 600, 620 and above. Of course, you want to remember tip number 2. This is tip number 3, by the way. But tip number 1, remember, you want to check your FICO auto scores first in advance before you go and apply. And if you're 600, 620 on your FICO auto scores, across the board, a credit union may not be a bad option. So, you can just Google search credit union near me. Some of them may want you to go and open an account with them to get the auto loan as well, and sometimes that's worth it. So definitely, consider that. Google a couple of credit unions near you. Give them a call maybe 3 or 5 of them, and have your credit ran by them, or have your application considered for an auto loan. Of course, ask them questions in advance. What score model are they using? What bureau do they use? What score do they require? Kind of get some information in advance from them before you decide to do that. But credit unions are great. They're phenomenal, great customer service. And they offer very, very low interest rates on vehicles. So definitely not a bad idea to consider before, going to the bigger banks like Capital One, Chase, Wells Fargo. If you're going to go to a bank and get approved for a loan first to buy a vehicle, I would highly recommend going to a credit union. And so same process on that. You get approved, you get your financing, you take your financing with you to the dealership or to a private seller, whoever it may be. Buy your car, and the credit union will cut a check to the dealer for the financing, and you pay back the credit union for your car loan. Okay, so tip number 4, if your credit score is low, if your credit score is, let's say it's below 620, you really want to try to avoid financing something old. Okay, so if you're not quite above 620, or if it's kind of borderline credit. If you finance something older, like an older vehicle, then that's going to add to the already, high interest. Okay. So the older vehicle, the more miles it has, the dealers or the lender is gonna, obviously the interest rate is going to be higher because the lender's looking at it as, well, the vehicle may not last that long. It may have issues. And if it is, we need to try to make as much interest on the loan as fast as possible before maybe it defaults or, it gets sold or whatever the case may be. Okay, so they all calculated that. They calculate the interest rate, that way. And so you really want to make sure that if your credit's not that strong, don't make the situation worse by going and getting a much older vehicle. And older, what does that mean? I probably would recommend something 4 years or newer, right? Something doesn't have to be brand new, but 4 years or newer, and really check the mileage. Okay, so not only check the year that the car was made, but also check the mileage to see, how much wear and tear does it really have. A good rule of thumb is, generally a vehicle is going to probably add, 10 to 12,000 miles per year. So if, the vehicle is like 3 years old and it's got 30,000 miles on it, it's actually not a bad idea. Plus, someone else already paid for the depreciation. So once that person drove that new vehicle off the lot, they've already, paid for the depreciation, so you don't have to. So you're walking into a fairly new vehicle. The value is going to be a lot less because it's already been driven off the lot, and you can get a pretty good deal on the financing because the purchase price is going to be much lower. The interest rate shouldn't be that high. And if your credit's not that strong, it'll kind of even out in the end, where you may not pay that high of an interest rate, especially if your credit's not that strong. Clearly, you want to work on your credit, get the credit as high as possible. But if it's not that strong, low 600s, high 500s, then you may want to consider definitely trying to finance something new. Don't fall in love with something older because you can run into some trouble there if the car is older and the bank wants to increase the interest rate, and of course if the vehicle breaks down in the future, there's some issues with the vehicle in the future, then you can really have a problem on your hand, because if you've been paying a lot of interest the first couple months, the balance really didn't come down, and the value of the car is basically upside down, then you may have some trouble selling or getting rid of it if it's got a lot of issues. So something to really consider before you go and apply for an auto loan. Do your research on cars, find ones that last a long time, find some that are not that old, that don't have a lot of wear and tear, kind of use that 10 to 12,000 mile per year marker. If the car's 2 years old and it's got like 50,000 miles on it, then that might be an issue. That's a lot of wear and tear on there. That may not be a good deal. All right, so tip number 5, very last thing I want to throw out there is be prepared to walk away if the interest rate is in the double digits. And what I mean by that, if it's like 10% or more, I've seen interest rates as high as 29%. That may not be a wise purchase to make on a vehicle, because remember, vehicles don't go up in value, they go down in value. So, considering that the vehicle is going to go down in value, you're going to pay most of your monthly payment is going to be going towards interest. So the balance is going to take a while to come down, and especially if you don't really put any money down on it, and the vehicle is losing its value, you're not really putting yourself in a good position, a couple months or a couple years down the line, if you decide you need to sell it or trade it in, because you may carry a lot of that negative equity over to the other vehicle. So I would recommend, if you don't have to have that vehicle, if it's not an emergency, or you can borrow someone's car, or you can buy a car cash for the time being, try to go that route. I get it. Sometimes it's hard to move around. You got work, you got kids, you got school, you got to have a vehicle, you got to move around. But also consider your finances for a bit. Don't put yourself in a position where you can be set further back because of the financial decision you made when it comes to your auto financing. Really consider that. So be prepared to walk away. Be okay with walking away if the interest rates are not favorable for you. Don't commit to something that is going to put you in a bind or put you in a worse spot. And I say double digit because if you work on your credit a little bit, you get with the credit union, you can get single digit interest rates, even if you don't go to a credit union. If you just go to a normal bank or go to a dealership and they shotgun your credit around, let's say your credit score is 640, 660, you got a good auto history in the past, you shouldn't pay too much in interest, and especially if the vehicle is not that old, then you should be okay with that in terms of interest rates. So really consider that. Really be prepared to walk away if the vehicle is going to put you in a bind. It's double-digit interest rate, may not be a good purchase, good decision, and be okay with waiting maybe a month or two to kind of work on your credit a little bit, get the scores up, and get the financing that makes sense for you and is not going to put you or your family in a bind. Last option there would be to consider a cosigner. If you have to get a cosigner, mom, dad, wife, husband, brother, sister, whoever, obviously try to get someone close to you, someone that you know and is willing to co-sign for you. But do them a solid. If they're going to do you a solid and co-sign for you, do them a solid right back, which is set up some kind of agreement, whether it be verbal and writing, that you're going to do everything in your power to work on your credit, get your scores up, so that you can basically finance the vehicle into your name only, basically refinance it down the road, maybe 6 months to a year down the line, finance the vehicle into your name only, get their name out of the picture, right? Get their name off the loan, then the loan is in your name only. That actually may make it attractive to them if you have some kind of agreement set up to where, in 6 months or 12 months tops, your credit is going to be strong enough where you'll be able to refinance the vehicle into your own name. You'll get them out of the picture, because one of the main reasons why people are afraid to co-sign is because there's no really plan put in place. Most people don't want to co-sign forever. They don't want to run the risk of their credit being destroyed because of you're missing a payment or two, and that's going to really hurt them and their ability to get credit. Maybe they want to buy a house in the future. Maybe they want to buy a car of their own in the future. So you don't want to really put them in a bind. So if they're going to do you a solid and co-sign for you, do them a solid. Maybe have a written agreement drafted up that you're going to promise to get the loan out of their name in 6 months to a year into your name, so they can get out of the picture. And maybe that would make them feel much better about co-signing for you, as opposed to you asking and begging and not really have a plan. That may not work so well, as opposed to having a plan, have an agreement in place. That may make the appeal to co-sign for you more attractive. So that's my time today. If you like this video, be sure to like it. Also, if you want to learn more about more credit information or want to stay up to date on credit news, I talk about credit court cases, the FDCPA, FCRA cases. I talk about the bureaus, what's going on with them, new credit score models are coming out. You want to stay in the know on credit information, be sure to subscribe to my channel or follow me on Instagram. And of course, check out joechavarria.com/links for more helpful information around credit. And if you have any questions about this video, drop them in the comment section below. I'll be happy to get all your questions answered for you as fast as possible. Again, I'm Joe Chavarria. This has been another episode of the Joe Credit Show. I'll see you in the next video. Take care, guys.